Welcome back to another live stream. Hopefully you guys are all having an amazing day over here. We are live for the FOMC meeting. I hope you guys are ready. This is going to be a very, very interesting afternoon. Odds are we are going to be getting a 25 basis point rate increase. But the most important thing is if we are going to get Jerome higher for Powell or higher for longer Powell or Jerome fuck your puts Powell. So we'll see what his guidance is actually going to show us. I mean, I might do something a little bit here going into Powell just for fun. Use some of the Facebook profits on that one, that trade that you guys saw me take on the previous live. But team, again, it's FOMC day. Make sure that you guys are slapping the literal living shit out of the like button on the way in over here. Spread these streams out to as many people far and wide so that they can be caught up to date on all the important things actually happening in the market. This is going to set the tone really for the summer. It's pretty important. All Fed meetings are very important here. Hold on, let's see. But yeah, let's see what we're going to get, team. We do have about 14 minutes to go until the Fed meeting. This is going to get very interesting. You traded that meta to the upside. Yeah, I caught the bounce on it and traded it back to the upside. Let's see here. Let's see. Using the profits to hold the YOLO and video calls. Okay, that's fine. You got a Mr. Porter ad? Oh, that's pretty cool. Make sure you test the sound first. It'll be fine. I just gotta switch some shit around on here. Like the audio. I gotta do this, I believe. Yeah, we'll figure it out. I just gotta click some random stuff on there and then it comes back on. We'll figure it out within like 2 minutes. But let's see here, team. Off a thigh gap? No, it was just off a knife like that. I mean, it was, you could view that as almost, I mean, you could say, oh, he caught the falling knife, but it's like, no. I caught this off of like here to up here and I was out 30%. I was out of that. This thing, I mean, the news wasn't really that bad. Typically on news plays recently, it makes more sense to inverse them. They don't get that continued move. I mean, Facebook kind of did for these 9 minutes here, sell and sell and sell and sell. And as soon as it showed signs, bottom, boom, right back up. No, it wasn't really a thigh gap trade. I could have thigh gapped it into here and rode it back up, but no, that was just a quick flip. I was basically just playing it off the premiums. But let's see here, team. Everybody, we are 15 likes away from 50. I appreciate you guys. Remember, everybody, you guys are in the right place. You finally found your home. Remember, everybody gets a free month to the Trade 1348 platform over here. So make sure that you guys are taking full advantage of that. Use code GAINS. The link is at the top of the live chat there, but I will throw it in here for you guys as well. Again, you guys see all the success that our members are having. You see the success that I'm having, that Gabe's having, that the algorithms are having. Come see why thousands of people every single day are changing their lives in the stock market, man. So again, you get access to all of those real-time unusual options activity notifications. You get all of the alerts. You get the AI algorithms that we have for you guys, all 25 something of the curriculum videos that we have for you guys. It's really, really special what we have going on here. So if you guys want to keep getting led to the slaughter, don't click that link and join. If you guys want to come and change the way that you think and view the market and actually change your results for the better, let's do it. Let's do it. All right, 12 minutes until the rate decision. This is going to get interesting. 100% news moves haven't hit like the same since the middle of 2021. Yeah, it hasn't. So usually it's the reversion move makes a lot more sense. Let's see. All right, folks, here we go. Been a while. Here we go. What up, Ryan? How you doing, buddy? You just switched 2 accounts to give you 2 likes. Thank you, winning loser. I appreciate that. Yeah, guys, keep running that number up. I mean, again, if we do hit 500 likes on the stream, I will do ankles, but that's a weird thing because there's new people now that don't understand it. Spy fucking around. Let's see. You're scared? Don't be scared. It's going to be fun. Yeah, I drilled the futures trades this morning. There was the one that I hit. It was basically a bottom tick. The low was a tick below where I entered intraday. And then there was another trade that I could have taken there that I walked you guys through. I was like, I'm not taking it, but watch that 1 minute 200 EMA or not the two. No. It was this right here. It was this bounce right here, this initial one, which was an absolute gem. If you guys hit that one, congratulations. That was really, really, really good. The one that I hit was in here. It was this move up to the upside. So those were easy. I didn't want to fuck around with the inflated premiums today. That futures account is either up 17 or 34%, depending on how you look at it after the identity fraud nonsense. So team, Someone say ankles. Now you're more scared? Nah. I should make a video explaining the story of ankles. Yeah. The other thing that I want to talk about here, guys, with you before we get into it, you guys saw me, and you guys see me do this every single day when people ask questions that aren't answered in videos. You have to be very careful with your wording in the streams. If you just say, hey, I have a question about this, I'm always going to refer you back to the videos because those videos are very in-depth. If you guys have specific questions on things, shoot me a message on Twitter or Instagram, mainly Twitter. I will see that the quickest, and I will get back to you guys. I'm here to help. But if it's just going to be a broad thing that I know is answered in the videos and you guys keep doing it, it's like, why aren't you putting in the time and effort to watch them? So that's that. Well, let's see. Since there likely a lot of volatility, would you buy a market order? Absolutely not. That makes it even less likely that I would use market orders. Ho! Look who we got here. Hi.
It's me. Hi. Oh, dude, I'm just calming down now.
I know. I'm fine. It's gonna be good. Geez. We're gonna be fine. Don't you worry. This is gonna be interesting though. There's actually only really one thing that I'm listening for in the press conference today. It's that new bond purchasing situation in 2024. There's definitely gonna be a question on it. And we have to be very aware of what that response actually is because it's basically telegraphing QE. And here's what I want you guys to realize about when the Fed starts telegraphing their moves. We all knew, remember, we knew that when the Fed started to say balance sheet runoff back in last September, and it started happening in November, we all knew that the market was going to come down. That was it. The party had stopped. Or no, it was 2 Novembers ago. The party was over. So what you have to realize now is that it's very possible that the opposite could be happening. Would bond purchasing be bullish? If they buy a bunch of bonds, yes, that's basically an element of QE. So if they're going to telegraph and say, okay, we're going to repurchase a lot of these bonds, then it tells us something about where they're trying to do and what investors can then do to position themselves accordingly. It's going to take a lot of time to play out, but that is the main thing that I'm looking for in the press conference. Let's see, though. All right, guys, keep smacking that like button on the way in. Oh, my God, we have a shitload of slackers in here. Guys, it's Powell Day. Keep running those numbers up. I mean, if we do hit 500, we will do ankles. But, yeah, this will get interesting. It's a party now. You guys look cute together. Oh, thanks, winning loser. Let's see.
Wait for 2 o'clock to hit.
Let's see.
Can't wait. And
let's see. Yeah, keep running those numbers up, team. Let's see. Oh, there you guys go. There you guys go. What do we got? 7 minutes left until the initial rate decision. We're going to go through all of the statements, and then at 2:30, we're going to have the press conference. So, actually, what do we want to do here? Do I want to play SPY or do I want to play SPX if I want to do anything? Let's see how shitty they're making these premiums an hour or so later. I mean, they're not that bad, but they're not good. Okay, here's what I'm going to do. Hold on. All right. Let's see. Yeah, I mean, that's the one thing I'm really focused on. I'm just looking to see if I want to set anything up here. Like, I kind of do. Okay. Okay. 'Kay. 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 'K Hold on. Let's see. I gotta do this. Okay. Then I need. Okay. What are you doing over there? What are you doing over there?
Shh.
All right, guys. Let's see.
Doing some
Let's
wizard
see.
shit, man.
I'm not gonna do what everybody thinks I'm gonna do.
Yeah. 5 minutes until volatility. I can't wait. Give it to me.
Okay.
Hey, look at NVIDIA trying to break its 200 on a 5-minute.
Is it?
Yeah.
Ooh, that's not what I want. And then we're gonna do this. Cool. All right, folks. Hope you guys are ready. I
Yes,
have
sir.
positioned myself.
3 minutes until all kinds of fuckery.
Mm-hmm.
I can't wait. I can't wait.
A candle. I've explained to you guys in the past how I do this with Powell with limit orders and things. I'm not gonna say it now. I'm not gonna tell you like all the nonsense that I do, but let's see. You've paper traded Powell speeches
Be
enough to know
careful
that I
what
don't
you
have the
say. They
stomach or the
might
skill to
ask you
trade
a
them
million and
live.
one fucking questions. Calm
What?
down.
What happened?
Be careful what you say. They can ask you to do a video about it.
Then not watch it. You're not gonna fuck around and find out. Smart. Smart. Yeah, I'm really just the most interested in like what he actually says, but like I'll play around for fun.
Mm-hmm.
So the strangle that I have is slightly green, but it's flickering.
NVIDIA has decided it wants to be a tech company again.
Is it running? Oh, that 280. Dude, that daily level there, that 281.20. That could get spicy. All right, we have 2 minutes to go, everybody. Oh my God, we have 150 slackers in here that have not hit the like button yet. Make sure that you guys do that. And remember, everybody gets a month free to the platform here. So use code GAINS. There you guys go. There's that link. Make sure you guys are hopping in before it's too late.
Mm-hmm.
All righty. 2 minutes. Should we throw up SPY or SPX? I feel like SPY is a better one to look at here. One minute warning. Here we go.
281.10 is your level.
Here we go. 1 minute. All righty, team.
I'm ready. I'm ready.
Whoa, my strangle is both sides green right now. That's interesting.
Both sides.
Yep.
Okay.
All right, 20 seconds. 14, 13, 12. Here we go. This is going to get spicy. I hope you guys are ready. This is going to be fun. 2, 1. Here we go. Candle. Come on.
Kill switch engaged.
Are they cocking it? Are they going to cook it?
Kill switch engaged.
Oh, here we go.
Look at her go. And NVIDIA just broke right through a level.
They're cucking. They're cucking. Let's see. All right. Fed raises overnight interest rate by 25 basis points. So we got a 25 basis point hike. That's what we got.
Let's go. All right. I'm out of this. I'm not going to fuck around and find out.
They've cucked the premium so far. Let's see. Let's see. It's got it. Fed said it will continue reducing balance sheet as planned. Very interesting statement there with what's been coming out about that. This is really flat here. So this is the first 5-minute candle.
Okay.
It looks like a cuck. That's what it looks like right now. Let's see what happens when Powell starts speaking, but this does look like a cuck. It's got to break in order for this thing to really go like up or down. It's got to break 413.50 or 410.50 in order for it to Fed omits prior. Oh, here we go. The Fed omits prior language that signaled more rate hikes ahead. That's interesting. The extent to which more firming needed hinges on economy. Repeats U.S. banking system is sound and resilient. Tighter credit conditions likely to weigh on activity. Will take cumulative tightening lags into account. This is a dud right now.
Yeah. Dude. My 290 NVIDIAs, I scored 12% on those.
Ooh, there you go. Let's see.
I'm gonna have to buy you a bottle for your birthday. I'm buying you a bottle for your birthday, son.
Are you?
Yeah, maybe 2.
We're gonna have some fun with this.
Oh man.
I think I get some free ones too because I'm cool. Dude, this is such a cuck. Look at this. They just cucked it. We got how much time until Powell here? 28 minutes. So nothing.
Damn,
No
that
blood.
SPY was violent.
Oh yeah. It's just fighting here. I mean, if it breaks. So basically what you're looking for now is to see if it breaks above or below this range. So right now you've got it more geared towards the ups, like the 413.50. And then what do we have down here? 411.40. So it's starting to get a little slippage here. Yeah, here we go. Here we go. Let's see if they hold this or if they want to take this thing down.
They want death.
Let's see. Mike, this is the Fed meeting, buddy. This is the interest rate decision. So 25 basis points, and they just cucked it here. That we got nothing going on. So we'll see. We will see what Powell wants to say later. In like what, 20-something minutes? Honestly, the only thing I really care about is that bond buying. That's it. Because they did say we're going to continue running off the balance sheet. But what they've done is given us a light at the end of the tunnel. You just have to see how the market's going to react to it.
Should be positive, sir. Let's see. Andrew, the reformed ape, staying out of this mess.
Smart.
Good call.
Smart. Yeah, we got about 25 minutes. They're not doing anything with this thing right now. Happy on the futures account today. 1 trade, 1 win, making money.
There you go.
All right. Dude, we're 6 likes away from 150. Thanks, team. You guys are killing it. All right. 7 seconds till a new 5-minute candle. Let's see what happens here. This could be the biggest dud of a Fed meeting ever. I mean, it was right. It was right at the. It was right at expectations. I mean, we all knew that we were getting a 25.
Yeah.
All right. Let's see if there's any more news coming through the feed. I kind of want to see if there's any other statements that we got to take a look at. US rate futures show traders price in rate cuts in September. That makes sense. Yeah, the only other thing is the Fed omitting prior language. Oh, that was a flash there. Hold up. Wait a minute. Yeah, that's really it.
No, the bigger moves happen now. They sort of kind of like calm down during the speech until he said something.
Yeah,
like,
and then we start moving. So this move here is just kind of nonsense. So we'll see. Don't the bigger moves happen during the speech though? They usually do, yeah. Like when he starts talking is when we see some wild shit happen, which is happening in what, 24 minutes? We got a long day ahead, team. We got this stream, then we got the midweek masterclass with you guys. Remember, everybody sitting in here right now, you all have 1 month free to the platform. Make sure you guys are hopping in there. Get access to all of the wonderful things that we offer you guys over there. Code gains, hop in. Stop getting led to the slaughter, man. Like, seriously. I was talking about this today a little bit in the stream. I can't even imagine how much money retail lost on Bed Bath & Beyond. Like, we told you. I mean, come on, dude. I wonder which next stock is going to be the retail investor donation stock when everybody's trying to hunt for a moon ticket, when everybody could just be sitting back using the compounding gains and making serious money in the market. Once you guys realize that, oh, the world opens up to you.
Yeah. Dude. I'm calling market shooting up. I actually have 4 6s in a row in my overall portfolio total. That's kind of cool. 4 6s. I know it should be 7.
What is it now? You said it what it was before. You want to tell them what it is now?
Oh, fuck. No. Nobody's business. It's up considerably.
Yeah.
Yeah. Yeah, I just don't want to be that guy. Percentages you're going to get from me. Every once in a while, I'll drop a dollar amount.
Mm-hmm.
Every once in a while, I'll drop a dollar amount. Like, that's cool.
Yeah, you guys get to hear from the guy every single day that made fucking 250,000 in a day last week and then made a video showing you guys how.
Yeah.
Your fucking Discord server guy is not even coming close to that.
Look at the spy pump.
Here she goes. What time's the midweek masterclass? 6. 6 tonight.
Yes.
All right, pal. What do you want to do?
Look at NVIDIA going for that retest one more time. Oh, yeah. You broke it. Broke the level.
Is it going? Oh, if it gets that close, that's the daily level. Ah! That'll be fun.
That'll be fun. If this trade... Yeah, this pans out.
I mean, we had... what we had off that bounce would have been... Like, it was still really good, but you would have gone nuts.
Yeah, it would have been a couple of million. Easy.
What was that? What was that? This fucking guy. Remember where you came from, bitch? Shut the fuck up. You can sit over here and thank me for warning you that everything was gonna come down. I had fucking 22-something thousand subscribers before I started talking about it and guided you through the entire time.
And we're still talking EMC?
Retail made y'all. We make retail rich. Your person makes retail poor. Gabe called it at 4. Oh my God, these fucking people. They're just never gonna get it.
No, they're not. You read my comment? What my son called himself earlier?
Yeah.
I smacked the shit out of him with a sandwich bag. It wasn't violent, but
should have been. Some people deserve to lose. Yeah.
Oh man. Let's see.
SV gonna lose it soon? No, I don't really care. You guys know the deal. The timestamps are there. We called it.
If SGV loses it, I lose it with him. That shit was
Yeah,
so
but you start
funny.
laughing because it's funny. I don't lose it at that stuff anymore. It's just like you can't fix stupid.
Oh man.
We're the only ones that are actually on retail side, which is hilarious.
So Jesus Christ, Kalik Brown. Like, come on, Kalik. Like, you're out here bitching that you didn't make $1 million off of what $250 invested in AMC. Like, let's be real. Just because you have like 6 shares in AMC doesn't mean shit. You have nothing. There's nothing, bro.
Mm-hmm.
You're a goddamn peasant. Just
Until Ape came out, it had a chance. And then when they fucked everybody,
yeah. Try to tell him too.
let's see.
Yeah.
All right, guys, keep smacking that like button on the way in. We got Powell in 19 minutes here. Ooh, SPY slipping. Hello. Kill it or rip it. I don't care. Above or below this one right here, this 410.50 or above 413.50. Just do fucking something. Like,
You do have a level 41107. You break that. Interesting. Next stop is about 410.30.
yeah. I mean, if it breaks 410.50, it's probably breaking 410.30. It's so close.
No,
'Cause
but
if
you
it
got
moves down here, it's probably gonna do it with
41107.
speed.
That's really where you're seeing price sensitivity at. There's a level here on a 5-minute that you could see. Check it out, 41107, and you get the wick. It's you see the wick there. It's
Yeah.
just responding off of it.
It's coming right back up now.
Yeah, I'm telling you guys, levels, they're everything.
Mm-hmm. That's how I'm fucking printing with the futures account. That's how I tripled it last week. And then I'm coming up to this week and I'm up what? Either 17 or 34%, depending on how you want to look at it after the what do you call it? What do you call it? The identity theft. Oh my God. He's literally saying Bed Bath & Beyond's gonna melt faces. It's fucking bankrupt, you dumbass. It's fucking bankrupt. It's delisted. It's OTC. You're fucked. They're going to learn eventually.
Oh, man.
Oh, boy.
Wow. I think these are people who are just trolls, man.
It's just the amount of brain deadness in the market is like, thanks. I know who I'm making money off of when I trade. I know who I'm taking the other side of the trade of every time. It's great. Thanks. Thanks for the free money. You just said an at the money paper trade strangle on the spot. You said a conservative sell limit orders. You had a bigger account side. Those kinds of trades for zero. That would be interesting. Yeah. Yeah. Right now, the market's just waiting for Powell. Because we have what's just came out right now is like, all right, they removed the language about raising rates more. Now you have to listen to what's actually going to come out of Powell's mouth. Let's see. Kelly, what up, buddy? Silly question, but do the indicators mean anything when Daddy Powell speaks? I would look more so at levels. Like, yes, they do still mean something, but what you're going to be doing is playing off of levels. But should you be doing that? No.
No. Kelly France, what's going on? Hey, did you see Kelly? Kelly has killed it this week.
Did he? Kelly, how'd you do? What'd you do, bud?
Dude, I mean, he showed his actual dollar gains, but what it's looking like, it's like $300-400 a day. I mean,
It's pretty good.
yeah, a week's worth of trading pays rent.
Mm-hmm.
The rest is free. Man, that should be a slogan. Make rent free.
I like that.
Yeah.
Yeah, I mean the first day that I had with that dude, the brand new futures account was 1,000, but it's a small account. It's like, all right, well, I was up 10% the first day, flipping it, and then when when I had the heart attack in front of you guys, thinking that I had open orders, That was them just saying, hey, the identity fraud bank fucking said, no, you can't have this extra money. And I was like, darn. So then I had to trade with I had to size it down. So still making great money with it. Win rate's I can tell you exactly what the win rate is right here. It is for this week, 70.59%.
70.59.
Mm-hmm.
Dude, that's impressive.
It's not bad.
That's impressive.
It's a lot of trades too. I'm just scalping. Scalp.
Yeah.
Oh, good afternoon, Spy. All right, 15 minutes to go until Jerome.
Debit. Yes, he's streaming the Politalk in this live.
Yeah, I have it up right here. It might take me a couple seconds to make sure that the audio goes through, guys, because there's always that little weird restream issue. So there'll be a couple of seconds where I'm fucking around with stuff, and then we'll get it on there for you guys.
I mean, I could just bring the feed into the stream myself.
Oh, can you?
Yeah.
It just takes me like 2 seconds to make sure that the settings are right. On OBS, it would have been fine, but I would much rather have you on here than fucking have a good audio quality that I don't have to mess around with for 2 minutes.
All right.
So, yeah, we are going to be streaming it.
Let's see. Which version do you prefer, Yahoo's or CBS?
Go on. Can you do it on YouTube?
Yeah, I'm on YouTube.
Go to the Federal Reserve's YouTube channel, because that's like the legit link. So it's live right now. They're going to be playing music. You can just kind of mute it until you see Powell.
All right. So,
how does the debt ceiling affect Treasury bills and bonds? Do you have anything to worry about? Well, if the government defaults, then you're fucked. Are they going to? Probably not. Let's see here. All right, folks.
Let's see.
Bloop, bloop. Oh.
There we go.
Pow. Will the audio come through too?
It should, yeah.
Cool. Very nice. All right, let's see. We got 12 minutes to go. Nothing too crazy yet. Again, make sure you guys are hopping in for your free month. You want to come to Prince City with us? Love to have you. Oh, I hear it.
Yeah, we got me.
The Powell music. Oh, it's like elevator music. All right, team. We are waiting. Nikki Leaks posted something. Fed raises by 25 basis points as expected. Fed's policy statement softens the rate guidance in a way consistent with past pauses. Ooh, interesting. Deletes reference to some additional policy firming may be appropriate. That's what that other thing that we were referring to was. And it was a unanimous decision. So I'm looking at the statement. The U.S. banking system is sound and resilient. Tighter credit conditions for... Okay, so it's saying last time it was recent developments are likely to result in tighter credit conditions. Now it's tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. This is the extent of these effects remains uncertain. The committee remains highly attentive to inflation risks. Let's see, anything else has changed. The committee will closely monitor incoming information and assess the implications for monetary policy. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account accumulated. Okay, so yeah, so they're basically saying no more. Well, they're pausing. This is a pause. This isn't a pivot. This is a pause. Very, very, very different, guys. A pivot is when they start decreasing rates. A pause is what they're doing right now. Ooh, here comes a spy a little. Hello there.
Yep, NVIDIA running.
Nvidia.
Nvidia. Let's see what Jerome gets us. The comments on the pearl necklace in the short video yesterday, dude, I was just fucking with people. People that thought it was weird, I would just like put the kissy face emoji. Like, let's yeah, 10 minutes, team. All right, those of you guys that haven't hit the like on the way in, help spread this stream out. Let's do it. What's Nancy doing? Oh, Gabe.
What's up?
It's above the channel. Now it's back in.
Uh,
But last time 25 basis points was that it was ending. Now it's 25 and ongoing. No. That's the opposite. Ongoing is now, or ongoing was the previous one, and now it's 25 and stop. Pause is gonna pump. It shouldn't, but I think it will. It should. Let's see. The problem is that inflation is just so high now because of the QE pumps and stimulus checks from last. Yeah, well, true, but again, you have to think about it like this. You can't necessarily. They're gonna go back to QE. Like, you guys have to realize that, like, all of these, if everybody is in QE, nobody is. If everything is moving up at the same rate, it doesn't matter. As long as the dollar doesn't get too fucked versus other currencies, we're fine. That's the main thing that I think people are looking for, mainly in like the currency markets. But if the dollar can remain strong versus other currencies, fine. If things start to freak out and we're the only ones that go back into this bond buying QE type of environment over the starting in like mid 2024, then that's a problem. Because then other countries can come in and be like, well, it doesn't make any sense. Nancy's running. It wouldn't make any sense for us to have our money in United States or because then the value of them is just going to get fucked versus their own currency. It wouldn't make any sense. When the 1 minute chart starts to feel slow, that tells me your system and rules have this way easier for scalping. Yep. That's how it feels. I mean, when I'm scalping ES, it's quick, but it's slow at the same time. It's like I'm looking for a very, very specific entry so that I can have a point or so of risk. Ideally, I want to try to get it down below, but you guys will hear it sometimes when it just goes order fill, stop fill. Like my stops are so fucking tight.
mm-hmm.
They can't stay paused every other. No, pause in terms of like no more rate increases for the time being is what they're referring to.
I'm straight.
Let's see. All right, 7 minutes. Then we get Papa Pow.
Mm-hmm.
Let's see. Here comes the spy.
Yeah, I'm loving this.
It's trying to crank until Papa Pow. Hello. Let's see.
NVIDIA is getting pimped.
Is it? Oh, wow. Wow. There you go. Maybe NVIDIA is the one that gives all the large institutions the AI. So there's a condition that's like, hey, when you pump shit, you gotta fucking pump us too. You gotta pump us as well. You thought Biden was speaking at 2:30? Well, you thought wrong. You've got mail. All right, let's see.
You got mail.
You got mail. All right, 6 minutes. Let's see if I have any more of you affiliates I got to approve. Oh, we had a couple. Hello. What up, team? Yeah, you got to break 413.50 or break down below 410.50. Those are real. That's like the two ranges here. You've shot down here. You're up here. You got to break out of this in order to really see something crazy in either direction.
Mm-hmm.
You see AI falling by next year. Well, it depends on how rapid they can develop new stuff and what the use cases are going to be for that. You thought Biden was eating ice cream at 2:30? Well, he probably is. Ice cream, you scream, we all scream for ice cream. And giving money to Ukraine.
Oh, man.
Do you see they gave more money to Ukraine today, too? Fucking nuts.
Did they?
Yeah, I think they did.
Jesus Christ. Five minutes.
Let's see. LG, that was a rough one. All right, guys, keep smacking that like on the way in. You guys are crushing it here. Thank you, guys. I appreciate that. We're at like 50% right now. It's possible. If you guys run it up to 500 today, we will do ankles. It's going to be very weird for those of you guys that are new in here. Oh, here comes Nancy.
Yeah.
Here she goes.
I like it.
Amanda peeking as well. Very interesting. You want to talk to AI on a daily basis because it makes them more productive. That's why.
Yes. Oh. Nancy is fucking storming right now.
Did it hit 283? Oh, shit, it did.
Yeah.
Dude, I'm hunted. Fucking AMD over here. I like this. Off this level down here. Ideally, I want it above this, 83.90. That's the 200 EMA on the daily.
Mm-hmm. Oh my God. Nancy is just destroying shorts once again.
Mm-hmm. It's a squeeze.
Oh, she's a wrecking ball right now.
Yeah. Spy breaks that 430. Did you hit the button?
Yeah, of course I did.
All right, 3 minutes, team. Here we go.
It's happening.
It's happening. This is gonna be fun.
Looks like Nancy's
back to where we were in 2006. Oh shit. Yeah, that's interesting. This is where the Fed funds rate was in 2006. Very interesting. Very interesting. Yeah, I'll throw for those of you guys that still want to hop in, I'll throw that link for you guys in the live chat. Remember, just use code GAINS and you guys can hop in there for 1 month free. I mean, you're doing yourself the disservice of a lifetime not taking advantage of that 1 month free. That's not going to be around forever. The price it's at right now is not going to be around forever. Make sure you guys are hopping in if you're interested, man. Stop getting led to the slaughter like that one dum-dum that was in here. That was like, my OTC bankrupt stock is going to go to the moon. It's not. I'm sorry.
Oh my God.
How many times do we need to be like spot on, fully correct for you guys to just realize what's going on here? Oops. Let me guess what Pal's first comment will be. It'll be good afternoon. I forget what he says. He usually says something.
Bet you $50 he still says the word transitory.
I don't think he will.
$50.
I don't think he will. I think he's gonna say, hold on. I think he's gonna say a lot of things, but I don't think transitory is one of them.
Just fucking with you. Would it be funny if he did?
It would be funny if he did.
Yeah.
All right, 1 minute to go. Here we go, team.
A year.
What?
He makes like 400,000 a year. I mean, granted,
no, I think it's like 160, 170, or like.
Is it?
Yeah, it's low. It's like
low.
Oh
yeah, you're right. It's the president. Makes
all right, here we go. Can we turn that volume up on there? I did not see that coming.
It's happening.
It is. All right, team. Hit that like. Let's do it. Let's do it. Wait, what happened? Oh, here he is. Good afternoon.
Good afternoon. Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Gina.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate. So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation at 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is so. Let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel.
Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default, and what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Steve.
Oh, thank you. Yeah, Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle, that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank which talked about the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about that I recall anyway about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't it wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves are many banks are now are attending to liquidity and taking opportunity now, really since the events of early March, to build liquidity. You asked about the separation principle. Like so many things, it's very useful. But ultimately it has its limits. I mean, I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities, and at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was, they're pointing out something that they're working on and that they're on the case. I'm not sure whether they mentioned, I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank and there are many other banks that are experiencing these things, and we're on the case.
Thank you.
Go to Victoria. Hi, Chair Powell. I wanted to ask you, obviously with the recent bank turmoil, we've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large size banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Let's go to Colby.
Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. When we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it. That's really all we can do. As I say, it does complicate. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now. But nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
And a follow-up on credit, if I could you give us a sense of what the SLUICE survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLUICE on May 8th, in line with our usual time frame. And I would just say that the SLUICE is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Go to Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last two meetings, been seeing the effects of those moves. Why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't, with economic data, you can't. You've seen, take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that, that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably, you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what most people many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation, as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
Would you be okay with a prolonged 3%?
Let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process, I think we're gonna need to stay at this for a while.
How does the other side of the mandate, the jobs side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Matt. Hi, Chair Powell. Matthew Bosa with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%. Pretty much where it was, even lower than where it was when we started. So
I realized this was Game of Thrones.
Job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems that to me that it's possible that we can continue to have a cooling in the labor market
air conditioner
without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is, I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above
What
levels
the
that would be
fuck?
consistent with 2% inflation.
Look at that neck.
See that as well?
That
And could you
neck
kind
hair.
of explain, how you
What
come
the
to that
fuck
judgment?
is that?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four, and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in expansion. So. Yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that, if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time.
Thank you, Daddy Powell.
By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that, that wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have expanded, did expand sharply during this inflationary period. And while there are some signs that
Jack,
they are
I
starting
found
to
your
decline,
Lego piece.
many economists
Look at
note they
this
haven't fallen as
motherfucker.
much as might be expected, given that we're seeing at least some pullback among consumer spending. So, speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten, back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is? Your policy
He's invisible. Oh, there he is.
Just ask about the fucking bond buybacks. That's all I want to know. The bond buybacks for 2024. That's all I want. I don't give a shit. We already know what
is going to happen. Are you ruling out the rate cuts that the market has
important.
priced in?
I didn't catch the last part. Rolling.
I just want one thing.
Rate cuts by
What
the end of the year,
part?
do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it will, of course, it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now, and going forward is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. I just we'll be looking at everything. It's again, I would just point out we've raised rates by 5 percentage points. We are shrinking the balance sheet, and now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we'll be thinking.
What about the idea of rate cuts?
Yeah, so
that dude looks
on the
weird.
committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate and to cut rates, and we won't cut rates. If you have a different forecast, and markets have been from time to time pricing in quite rapid reductions in inflation, we'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down. Particularly now, if you look at non-housing services, it really hasn't moved much, and it's quite stable. And so we think we'll have to demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress.
Fuck it, I'm
Do you think
inclusive.
it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing. We don't think now. It hasn't actually been growing. It moved up, it moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now. What happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan Banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits.
Damn, I take that
and spreading
back.
them
She looks
around,
like the
things
fucking
that.
Predator.
It doesn't seem to have had any effect overall on the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Sarah Ewald-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country?
They're all
markets,
looking
and
weird
borrowing?
now. Like, what the fuck?
Yeah, I would just say it's. I don't really think we should be. We shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say we don't. No one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the regulatory, the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way. A large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that it may just have been technology evolving, we have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. What our job is now is identify those things and implement them. And that's kind of the only thing I care about and I feel like I am accountable for doing everything I can to make sure that that happens.
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way. There were three large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period is an important step toward drawing a line under that period of severe stress, okay? I also think we are very focused on what's happening with credit availability, particularly, with what you saw in the Beige Book, and you will see in the SLOOS is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
Okay, Greg.
Thank you, Fed Chairman. Greg Robb from Market Watch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the last.
What the fuck? Look at that alien.
You say a couple of times that you deferred to the vice chair for supervision. Do you think that was the right way to go about this? And comments on that. Thank you.
He talks like Arvin.
Let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations. And I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the vice chair for supervision, the place to start is the statutory role, which is quite unusual. The vice chair, it says, shall develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as vice chair for supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel, my input privately,
And that's, I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires. And, you know, but it isn't, I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and discussing, having an intelligent discussion about what's going on and why, and you know, that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors, and really in supervision has sole authority over supervision.
Just wondered if you had any regrets, or was there anything that, you know, decisions that maybe you regret now in light of what's happened?
I've had
a few. Sure. I mean, you know,
that guy looks so fucking weird to me.
Done things differently, but honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and
Albago, I want you to look at me
I think
the same way he looks at Powell.
Report is an excellent first step in that, but we've got to follow through.
These questions are actually terrible, too.
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again, or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board.
It was unanimous. Yeah, it was unanimous.
A number of people.
Why even ask that question?
I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. You know, that we're, I mean, there's a sense that we're much closer to the end of this than to the beginning. That, you know, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close, or maybe even there. But that, again, that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed in to determine whether there's more to do.
I'm curious too how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
He's like, bitch, if you don't shut up.
I couldn't really say. I just think I think we've moved a long way fairly quickly.
Like, these questions are just like,
we can afford
maybe
to look at the data and make a careful assessment.
And we'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right
You
lessons.
used to be hot.
What are
Maybe.
those lessons?
A 3.
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that, that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that then we're going to revisit. It's pretty clear to me anyway. It's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
That was just so fucking shitty of a thing. Hold on, can you mute it? Can you mute that? All right, team. We're going to do a little bit of a recap on this later. I'll talk about it in the masterclass stream with you guys a little bit tonight. Can we get Nancy Pelosi to join the Discord? No, we print more than Nancy Pelosi does. So again, guys, the questions were fucking terrible. They're like, did you guys talk about pausing? It was a unanimous decision. Why do we care if they talked about it? Obviously they did. All right. So we got to talk with you guys about the bond buyback stuff. I'll look into it a little bit more. Other than that, guys, hopefully you guys didn't do anything too stupid during FOMC. We got another really crazy day tomorrow. Make sure you guys hit that like button on the way out. Oh, I will throw the link for all of you guys, all of your guys' free trial to the platform in here too. You guys want to join the best place to come and learn to trade? Use code GAINS. You guys are good to go. But team, we're out of here.